Hi guys, today I am discussing the strategy which are very profitable and beginner perspectives. Here I am majorly discussing about behind the factors, the strategy, how to create a profitable strategy. As a beginner, you can learn here how to create a profitable strategy by using different aspects of market. Majorly, according to market conditions, we have to select the best instrument, and whenever going to the implement the strategy, we have to at least 3 to 5 years of market data collection. Then and major we are focusing about capital requirement of needed to the strategy, and we have to expect returns, how much we can expect this strategy. Here calculations about credit and debit points and executing the strategy. Finally, golden rules, we have to follow these rules, we have become as a profitable trader. Let's go to presentation. Majorly market are 5 types. At current market price to market will go up, sharp up. I am coding as A. And market go to slowly up. It is marked as B. Yeah, otherwise current market price to markets will be same in the range. It is the C, like this one chart. And also market will be slowly come down. It is as D, like this one chart. And last one is market will be suddenly fall will come. It is like E. Every market will be match one of this type of markets, but not exactly identical, but some look like same scenario. It will be bounce every time. But the trader who are identify the market type, they will become to more success. Majorly identify the market type is important. According to market type, choose the best instrument. Okay. Now I have to select the best instrument according to market types. There different type of markets is there, where equity derivatives. Derivatives have two types, futures and options. When where if you are going to the equity, what will be happen? Check once. Whenever going to the equity, we can only buy the stocks. Where if market, where I am differentiate with the market types A, B, C, D, E, and type of trade and instrument here. Where if you are buying any stock, where market will be go sharp, we can profit. If market goes slowly up, we can also profit. If market in the same range, zero loss, zero profit. If market goes slow down, it will be loss, and market will be sudden fall, it will be loss. Here only 40% of chance to profitable. And now going to the second option, where derivatives. Derivatives has two types, as long and short. Where you can long the position, if market will go sharp up, we can profit. Slow up, we can profit. Within the range, no profit. If slow down, we have to loss. If sudden fall, we have to loss. Where 40% of chance to profitable. And short the position when market will be go sharp up, use loss. Then slow up, also loss. If in same in the range, zero loss and zero profit. If go slow down, we can profitable. If short fall, we can profitable. Here 50% of chance to profitable. Then going to options. Where option, this one is options. Where options is two types again, option buyer and option seller. Option buyer can manage two type of market, can market go up or down, or option seller also managing the total market. Where if option buyer can call buy, they will profitable when market goes sharp up, and if market goes slow up, there 50% of chance, means where some option decay will be appears. That's why he can make profit but less time, less profit. If within the range in the market, there will be zero, that means he will be loss. If market slow down, he will be loss, and market will be sudden fall, he will be loss. Then percentage of profit is 30% only. Where If someone buy a put where if market go to sudden up, he will be loss, and in the market condition too loss, within the range loss. If he slow down, it will be 50% of chance to profit, and sudden fall it will be profit with 30% of chance to win. Where option seller, where if someone call selling it, if market will be sharp up, you will be loss. If market will be slow up, you will be 50% of chance to profitable and 50% chance to loss. Why? Because you will collecting the premiums. That's why they managing option decay will be supporting to the option sellers. That's why you will making the some profit. And market within the range, you will be profit. Market slow down, you will be profit. Short fall, you will be profit. Finally, option seller will get 70% of chance to make profit, and put seller will be make profit when market go up sharp or slow up or within the range. Even though market slow down, you will be 50% of chance to win. Only loss rate sharp fall down to market, where option seller 70% of chance to winning ratio. So finally, we conclude the best instrument is option seller. Now we have to selecting the option selling. Now where you are selling CE, call selling, they will be covered the different type of markets. C selling covered C type of market, it will be flat, and D and E slow down market, sudden fall. Three type of market will be covered by C selling. Even though market slow up, 50% of chance to profitable. And put sellers, it is covered the three type of market. It has flat, slow up, sharp up. Even though market slow down here, it will be 50% of chance to profitable. Next, but major question is how much distance far away from the current market price. We have to selling, okay, we have to idea, okay, we have to sell the call and put, we have to profitable, where majorly most of the type of markets will be covered by call and put sellings. But how much distance we have to go, this is the major important factor. We have to know the distance according to market data collection, where now going to the market data. See the slide. Banknifty monthly range percentage from January 2017 to January 2022. Check the graph. Where check percentage, right? The market most of the time 10% above and 10% below. In the range only, most of the time it will be in the 10% range. That means Bank Nifty monthly range will be 10% above or 10% below. It will be move this range only. Where cross the break even points how many times in 5 years? 6 times only it will be move upside out of 60 months. It means most of the time Bank Nifty will be 10% above range or 10% below range of the range. Okay, you have to check market data, scan this code to go to direct historical data source is here. Okay, and then going to other slide. Now Bank Nifty weekly range percentage from January 2017 to January 2022. Okay, now check the market data. Now we have to draw the rectangle. 1 minute. Check the data. Most of the time market moves upside at 5% range and market downside is only 5%. In between the range market will be move in first 5 years. Where crossing the break even points 14 weeks out of 240 weeks. You can understanding the major important factor in this. Whenever you are going to the create a weekly strategy, you have to collecting the market data like this. Now we have to have one idea about the market. Market will be only move within a week it will be 5% above or 5% below in the current market price. It is the one ideology of ours. Okay, then going to the daily data. Now check daily data. What will happen here? See, this is the 5% range actually, but market will be most of the time 3 or 4. Actually 5, this is one line, this is 3, this one is 4, right? Line. This one is 3. Most of the time within the range, only 3% of range it will be move in a day, single day, above and below. Okay, right? According to market data, we have to conclude that 5% above will be move in the weekly range and 5% below in the weekly range. Now we have to create a strategy with from current market price to 5% above strike we have to select, and 5% below the strike will be select. Now selecting process will be completed. Now capital requirement and expected returns. Now going to the option selling. We have to sell options, but which type of option selling we have to choose? One, knocked selling or hedging, or far away distance hedging, where if we are selling a knocked positions, it will be required unlimited loss and high margin required. It will be nearly 1.5 lakh needed. If hedging with near strike price as a buying, it will be take margin 40 to 50,000. It will be limit loss and reduced margin is high. If far away strikes are buying for hedging purpose, it will be unlimited loss is retained, but only reducing the margin somewhat better. But always choose the hedging. Second one, this one only choose hedge very near strikes. Where if I'm talking about beginner perspective, beginners has using the 50,000 or 1 lakh or 1.5 lakh. Maybe they have to how much they can. Now going to the major important factors here. First of all, you have to choose intraday or weekly or monthly. Whatever you choose, if you are choosing the intraday strategy, you have to select only 1% profit you have to expect, not more than that. If you are expecting more, you have to wait, otherwise you have to take loss also more. Now if you are expecting the only 1%, your monthly ROI is 10%. I am calculating only 10 days for intraday. Actually trading days is 21 days, so maybe 1-2 hour leave holidays. Then out of 20 days I am only 10 days calculating. 10 days will be 10% returns of monthly, and yearly 120% it is used profit. I think you are also known as mutual funds and fixed deposits, where they are giving only 7 to 8% hardly. Now you are getting 120% is not a small amount, it is a huge. That's why you have to select 0.5 to 1%. It is not a small return, it is a huge return for intraday traders. And where weekly strategy, you have must to sell expecting the returns only 2%. 1 to 2%, majorly 2 will be easily getting to 2% returns. It will be 8% per month. Or yearly ROI, it will be 96%, and also it is also huge profitable. And monthly strategies, whenever you build a monthly strategy, you have to choose 6%. You have to expect 6% return. It is enough, and it will be huge returns, 72% of returns. Now whenever going to the charges, if you are going to 1 lot with the trade with 1 lot, you have to 96% for ROI, yearly ROI. I am talking about yearly. When weekly strategy, you have to you will get 72% of returns. Going to a monthly strategy, you will get 69%. But you have to increase this percentage. How? Whenever you have to go into 2 lots, trade with 2 lots, you will be increasing the profit. Why? Because whenever you have to trade, executing trade require to 200 rupees charge. Whenever you have to 1 lot also 200 rupees, 10 lots also 200 rupees. That's why I am always depend with charges. For charges purpose, you have to trade with 1 lot extra. I think you can understand this slide. Let me go to next slide. For example, Banknifty current market price is 36,205. This is the spot price. select the next week expiry for 4 legs. For example, we have to doing the 4 legs, that's why I am talking about 4 legs, where we are making the strategy. For example, 28th February. Now we are selecting the expiry date 10th March, right? Now how to calculate the process. Now 5% value we have to get with multiply with 5% in spot price, that is 1810. Now call sell at, what will we do, at spot price plus 5% value, you will get the upper value, means call sell. Now put side, you have to subtract the spot price of 5% value, you can get lower price put value. Now 38,000 is the call selling and 34,400 is put selling. Now coming to the next point, try to delta neutral or premium matches. So whenever you are getting these two strikes where premiums are difference or delta are difference, whenever now going to this example, calls 38,000, it premium is 260 and 34,400 premium will be 474. These two are very different, means so much difference between two strikes, two premiums. That's why I am going to the neutral, the delta. Now see the delta 2186, 21.8. Now 34,000 is 365. It will be somewhat difference, but delta will be neutral. That's why I am trying to the neutral the delta. Now for hedging purpose, I am always going to the 300 points above of call and below of the put. But sometimes 200 also works, but 300 is I am satisfied. Where C buying at 30,300, 194.7 and fee by 33,700, 314. Right? Now credit started. It means credit points means whenever you are selling premiums, 260 plus 360 equals 625, and debited points means buying premiums. There are 194 plus 311, 508. Now finally we will get 117 is credited to our strategy. Now main question in our mind, why should we select the next week expiry? There are few reasons to get next week expiry. Majorly get higher premiums. Whenever you are choosing the next week expiry, now getting the higher premiums. Second one is gap between the C and P is more and more, where you are getting the 4,000 more extra between the gap, 4,000 points. Now third one is 25% to 50% of chance options decay will be appears in current week also. Now higher probability of chance to profitable. For example, I am taking the one of the example in last week. Here 37,000 is the current market price. Actually I am forgetting to write the here 37,000 is strike price. Now I am adding 5% value above and below. That's why C is 38,200 and 35,200. Now I am entering here 14th February. This one. Now two premiums are equal. I am neutralize the premiums here. Next day this is 55. This one is 575. When this situation we have to adjust, but here I am checking the just example purpose. That's why I am retain the same premiums. Now 16th 439 and 70 and 17th it is the expiry day 248 and 81. Finally I am getting the premiums 26% as a premium is decay appeared in current week, but we are targeting week is next week, and in this week we are getting the premium decay 26%, right? 119 points. And next week also check same 18th 243.71, 21, 20, next 19, 20 is Saturday, Sunday maybe 178, 32 and 22, 64, 30, 23, 24, 6 and expiry day 0, 13. Finally in this week 70% and decay appears 316 points, but we are expecting the only returns 2% per week, right? Where 2% means in, for example, 50,000 into 2%, 1,000 rupees we have to expect. Now whenever you are selecting the next week, you are getting the profit in first week 1-2 days also. That means whenever you are entering 14th February, you are getting expiry day itself 26%, 119, 2009, nearly 3,000 rupees, but you are expecting only 1,000 rupees from this strategy, right? Whereas deploy the capital as 50,000 rupees. Now how to execute this strategy majorly. First of all, this broker which are allowed to basket orders, you can go with that type of brokers. Otherwise, you can use sensible private. You have to paid or free version also. It is allowed to the basket orders, where you have to choose. First of all, you choose strike price, add to all basket, and going to lot size. I am recommended to only 2 lots is better for one lot is the charges purpose. Other one is you can calculate by ROI. And the order type is limit order. Always choose limit order. And expiry, select next week expiry 9 days before entry, Monday or closing time, Monday closing time or Tuesday 10 to 11 between the time. Execute all trades with one click. Add to basket first, then click the execute orders. Now when will you exit the strategy? Whenever you get 2% returns of the profit, you can get profit 1-2 days also enough. Maybe 1-2 days you will get 2% of profits. Otherwise you have to wait. Second one is 2 days before expiry day. It means you have to get 9 days. You have to chance to wait the strategy for 9 days, right? Now before 2 days means you have to wait 7 days. Otherwise you can exit the strategy. Fourth one is adjusting the strategy when going to the different. That means you position is going to the wrong side. Now you have to adjust the positions. I will say there is no stop loss. You have to mind it. Just whenever going to the wrong your positions, you have to adjust the position to make profitable. If you want to know about adjusting, I will make new video. Please subscribe. Whenever you have to think about useful this content, you have to subscribe my channel and comment below any you have to any doubt. And payoff graph will be appears like this. Whenever you are deployed strategy, like it fund needed 50,000 rupees, 900, like around 60,000 rupees needed to you have to execute this strategy, and margin needed to just they can hold 42,000 only, right? Maximum profit 3,000 nearly, maximum loss 4,000, profitable is 61%, break even is 4,200 points, nearly 4,200 points. But you are required percentage of winning, your expected returns only this one 43,000 into 2%, where 850 nearly maybe comes. Whenever you are getting the 2% returns, you have to exit the strategy. Now going to the golden rules. These rules are very important. You must follow these rules. Always trade 1 lot extra for charges. I am saying previously, whenever you are doing the one trade, it must be charged as 200 rupees. Maximize our profits. Margin, always maintain extra amount for 1 lot. For example, you have to think about 2 lots trade. Now you have to consider 1 lot extra. Why? Because whenever going to the market opposite side of your positions, now you have to manage the 1 extra lot. You have to add it. Whenever you are closing the one pair of position, they are not allowed to that margin to instead trade. Always adjust the position. If trade going to run, but don't exit complete trade. Target should be 2%. Don't be greedy every time. Greediness not works. I think it is beginner perspective. If you have experience, you can expect the more returns also. Exit with pair in adjustment. Whenever doing to a adjustment, you don't only exit one position. Like sell position, you have to exit and add another selling position, where risk reward ratio will be unbalanced. That's why we have to exit any position. For example, you are selling call selling position, you have to exit also buying position. Okay, thank you guys. If you have like this content, please subscribe my channel. Thank you guys. If you like this content, please subscribe my channel, and I will upload another videos that is useful for you. Thank you.